Hey, it's Sasha Evdokov, founder of Rise to Learn. And in this video, I want to talk about options and how you can read an option chain. Now, it's important you learn how to read an option chain if you're trying to trade options. Now, you probably know already what the basic premise behind options are and what they do, but you need to know how to read the option chain. It's kind of like learning how to read the quotes behind trading stocks. And the same thing goes with options. With options, they're a little more complicated. So let me show you exactly how to read an option chain. And we're using the Thinkorswim platform on Bank of America. And I like this platform because a lot of people tend to look at it or use it, and it fits to pretty much any other platform because it has most things and you can apply it to your trading platform. But here we typed in Bank of America and we have the underlying, this is the stock itself, and we have 15.95 that it last traded. The net change was minus 39 cents. Bid is 15.92 and the ask is 15.94. Again, the ask is what the sellers are asking for the stock. The buyers are bidding to purchase the stock. So you'll always have that little spread or gap of negotiation. We have our volume, we have the open, we have the high. And here is our option chains. And since options are derivatives, they drive their price from the underlying. Then all these prices are based somewhat on the underlying price of the stock. So here is all the option chains, and we have the calls on the left and the puts on the right. And if we drop one of these down first, you'll notice how it kind of looks like. And you've probably seen this once or twice. If you've just getting into options, you've probably seen it. You might not know what it's all about. So that's why we're going into this basic video to explain to you exactly what an option chain is all about. So the calls is on the left, the puts is on the right. The calls is if you buy one of these, you're looking for the stock to go up. The puts is you're looking for the stock to head down. That is if you purchase just one of them. Now we have our options are based on prices for the month. So you can see here I have the May, we have the June, we have the July, the August, the November. And the parentheses here are how many days until expiration. The expiration time is always the third Friday of the month, with the exception of these irregular weeklies options. So you can see here they expire 5 days away, 12 days away, 26, 33, 40. But the standard monthly ones are the 19, 54, 82, 110, 208, and so on. So if you want to buy an option with more time premium, you can buy one in January 2015, and right now we're in April 27th, 2014, on a Sunday actually. So if you want a lot of time, you'll pay a little more. You'll pay $1.26 for this at the money, $16 as at the money. Whereas if you only buy it 54 days, it's 52 cents. So you can see that the price is nearly double to get some additional time premium. Now, of course, if you've studied a little bit about options, you know that they're based in 100 shares of stock. So every option that you buy is really 100 shares of stock. So looking at this deeper, now we're looking at the June 2014, 54 days out. This is the calls and this is the puts. And if we're looking for the stock to go up, we would buy a call. We can do something that's at the $17 range if we want, and we can purchase this one. And you can do so by right-clicking and buying or check-marking something. You'll have to look at your broker platform and see how you do that, but something to that effect is the way you do it. They may also have a ticker symbol here that you type in and you buy it. If you're looking for the stock to head lower, then you could do like a $14 put, and the same thing, you right click, you buy it, and you still buy the put because you're buying something that you expect to go down. So that's kind of the premise behind the option chain. Now, if you're looking for more time premium, of course, you're going to go a little further out, and these stocks, they have so many different time premiums. Stocks that trade a little bit more frequently, they will be something like an Apple. So here I pulled up Apple. You can see that here we have many more strike prices and many other irregular options like the minis, the weeklies, and then the standard 82, 110, August options, and so on. So if we still look at the 82 day away July options, you can see here the bid-ask spread is 10 to 20 cents, 30 cents. So it's a little bit wider than Bank of America. Here we have our theta, which is how fast the option deteriorates per day. That's how much money you're losing on your option. But you can change this. You can change it to open interest, and you can see how many people have an open interest in that option. You can see also and change it to volume, how much was being traded that day. And you'll notice that it changes also on the put side here. So here's our puts. Notice that it also changes there as well. So with different companies, you'll have many more strike prices. So you can see that here, not a lot of volume is traded, but for some people that have been in Apple for years with the options, let's just say they bought a 2-year option contract, they may have an option back here at the 495. And you can see here the same with the puts. This is why here you can change the strike prices if you choose to do so. And you can change it to 12, you can change it to 16 if you want, and so on. So that's kind of how you read an option chain. Now there's one last little thing I want to mention is here, this is the implied volatility for that option contract. And option contracts are priced based on the implied volatility, the theoretical value, and how much time you're buying, along with a little bit of a formula that goes along with that. So this is important to know and understand if you're purchasing a calendar spread. So in this month, you would want to sell a calendar or sell one option and buy protection later. So you notice that here you're selling an expensive thing or an expensive contract, and here you would be buying protection at a cheaper price. So that's what the implied volatility is telling you, that more volatility is in this month, so it's smarter to sell one here and buy protection here. So here, if you're looking to buy an option, you're getting a better deal in this month in July, since the implied volatility is lower. Here, if you bought an option, you're paying a little more because the implied volatility is technically higher. You can see that in Bank of America, it's actually reversed here. We have a lower implied volatility in the current month and a higher one in the future. And things usually get mixed with these volatilities depending on earnings. But here in Apple, we have a June 21. It's higher in the current month and lower in the future month. So it's something to pay attention. So like in Priceline, you'll notice it as well. June versus July, we have 35 versus a 33. And again, that's for if you're doing calendar spreads or you're watching to get a deeper discount on your option premium if you're purchasing something. But you can also change this to implied volatility, and you can compare it. You can see here, this is a 34 and this is a 32. So if you're selling an option, this would be a smarter one to go. If you want to buy it, you can probably go to the 82 because the 82 days out, July, because you're paying less in terms of implied volatility. Okay, so it's kind of like how a car is priced. If it's priced based on mileage, you're getting a lower mileage car in this month. Okay, so that's kind of how you read a basic quote window. So let me do a quick overview. Again, you type in your option ticker symbol here. The option contracts pop out, and you have the calls on the left, you have the puts on the right, you have your strike prices down the center, the bid, the ask, the net change, and the implied volatility. But of course you can change some of these to another value if you want, and then you can select your strike price based on the months available, and choose your month, choose your strike price, and then you can right click and buy it or sell it. And if it's a different platform, you can check mark it, or you can type in a symbol here and purchase the option. But that's how you read an option chain. It's not too difficult, and it makes it worthwhile to learn what all these things are doing for your option if you're looking to trade options. So that's kind of a very simple video for a beginner if you're new, and hope it was helpful. Thanks for watching, and if you enjoyed this video and you want to know exactly the stocks that I'm watching or the stocks that are breaking out, if you want to see exactly by the charts and by the technicals the stuff that I'm watching and what I'm doing, then go ahead, sign up to my newsletter and get the trading recaps for free. Anyways, thanks again for watching, and remember to do what you love, contribute to others, and most importantly, live life abundantly.